Rajesh Bhatia, CIO at ITI Mutual Fund, is with us now for some perspective. Rajesh, great to have you on. So it's it's good times all over again. One would imagine, one would hope. But are you in the camp that also feels that the worst of this correction is indeed over?
Well, we'll have to see about that. I think we should enjoy this bounce and we should not underestimate the extent of the bounce that can happen. But I think from a fundamental perspective, we are still in a slowing economy or a slower growing economy. And that challenge definitely remains. And the second challenge which remains is the uncertainty that has been brought about by the global macro factors. The US is probably trying to engineer a slowdown for their own reasons, but we should not underestimate the impact that can have on global growth, including that of India. So we are already in a slowdown, and if the US also slows down, which they probably want to, then my sense is that can become a bit of a fundamental challenge. And listen, basically we do require top-line growth, translating GDP growth, because given where margins are for the Indian corporate sector, we should not bet on a greater expansion of margins. So to get earnings trajectory, we do need top-line growth, which is we do need GDP growth. And that's really what is necessary for the markets to firmly decide that we are on the right track and that a bottom has been made to answer that question.
Mm. So it's too early to say a bottom has been made as of now, to your mind. You're not convinced. What about, how would you construct your portfolio in such a scenario now?
Look, what has happened is all inflection points in the market are drawn really by macro factors. And the trigger for the market rise from the bottom has been that the US dollar has retreated and the US 10-year treasury yields have retreated. There is some fear of a slowdown in America. There is a thesis that probably the government itself wants a bit of a slowdown to refinance some part of the fiscal deficit or the spot that they are in. If that be the case, that has led to this rally. I would say that why I'm saying that you should not underestimate this is because those factors are not going to change in a hurry. And the FIs that have come in probably could persist for much longer. So as far as I'm concerned, I'm enjoying this rally. And I've used this opportunity to buy sectors where I think there is strength. So last time also I pointed out utilities, power utilities are the ones where we have added money. We had added money in the private banks sector. I've also used this opportunity to buy digital commerce companies such as digital insurance brokers or payment companies or electronic manufacturing services companies which are leading the space, etc. They may well become trades, I don't know. But as far as I'm concerned, I can see that this is a strong rally and I should participate in it.
Okay. Hi, Rajesh. Good afternoon. Good to see you. Ben, couple of questions here. You're enjoying the rally. I love the sound of that, right? All of us are. Portfolios are feeling better. Your SIPs, mutual fund holdings, everything is looking good. So that's good. Tell us, what was the cash levels you were sitting on, say, a couple of months or so ago? And how much of that have you deployed at current reckoning? What is your cash in books? And, utilities is something that you've mentioned in the past as well. But which sector do you believe has run its course? And you would be a little bit, skeptical on that particular sector. So 2-point question.
So, I run a balanced advantage fund and, at the peak, we had more than 65% exposure to equities. We had brought it down to as low as 35, 37%. We are now back to 60+% or 60% as far as the balanced advantage fund equity allocation is concerned. So that's to answer your first question, where we do tactical allocation. The second question, where are we seeing weaknesses? Consumer is still weak, auto is still weak, consumer electronics is still weak. IT has probably given some bottoming out because IT stocks have corrected 25% or more. But I guess, they are at now attractive valuations. But those are some of the sectors that I think are weak. One other non-consensus weakness that I see probably can be capital goods. Because I think the leadership of the market probably could change. And capital goods were the leaders of the last cycle. It's possible that I think that capital goods may not do as well in this cycle as you move forward.
Okay, all right. Rajesh, just one more question on tech. That, as you said, has been a relative underperformer, but now valuations are looking pretty okay. And I think CLSA as well pointed out earlier today that most of the bad news appears to be in the price post the recent underperformance. I think my director as well will pull up the Nifty and say the tech index, and we'll see that tech has underperformed just in this year. From the tech basket, Infosys is something that you like. Besides that, what do you like? Would you prefer the large cap names or the mid cap names?
So, I mean, I would definitely prefer the large cap names because I think the large cap names all have yields of about 4+%, and they've come to about 20, 21 times 27 earnings. I think that's, fairly reasonable in terms of prices. Some of the mid caps are still very expensive. Some companies which are in the middle, they are larger capitalization companies, but actually growing at mid cap rates. I would say that those have become attractive as well. Those stocks have corrected by over 30-35%. So that's another category in the IT space that I think we have bought and which we like.
So IT, you're getting a little optimistic on it. That's an interesting call. I just want to, Rajesh, go back to that point that you made on some of the consumer technology companies, I think, right? That's a space that you're looking at. But can you sort of dive a little deeper? Lots of different companies from, beauty and personal care to, of course, food delivery, e-commerce, etc., and also some fintech players which are listed. So what part of it are you most convinced on? Because, for instance, in quick commerce, there's still a lot of cash burn. Companies are still in investment mode.
Yeah. So the fintech part of it, Surabhi, to answer your question, the fintech part of it is where I am where I've added more recently to my exposure.
Okay. All right. So tech you like, some of the consumer tech names you like. Overall on consumer, Rajesh, what's the sense? The seasonal sort of flavors do come in, AC stocks right now, etc. But beyond that, on consumption, Titan, of course, there's been a note doing the rounds today talking about perhaps weakness because gold prices have shot through the roof. What's your overall sense on consumer and what's the advice?
No, so among the sectors that we like, just to reiterate, are private banks, NBFCs, utilities, life insurance companies, telecom. There's enough strength in all of these sectors, and we continue to like them. As you pointed out, we think IT is probably at closer to bottom valuations, and digital commerce companies, particularly in the fintech space. Those are some of the areas that I think at least I'm excited about. As far as consumption is concerned, I'm not really seeing any reason to kind of dive in or become aggressive. So staples, I would say automobiles, none of these, and as you point out, some of the other companies are also pointing out that the demand traction is not very attractive. So, I don't have to be in these spaces. So I'm avoiding some of these spaces for now. And my sense is that there's enough on the other playground to kind of play and to make money. And there's greater predictability, there's greater visibility. That is what I look for. Where can I predict strength in earnings? And that's really where I want to be.
Thank you, Rajesh, for joining us in the conversation today. But confidence is truly coming back in the markets. Look at the way some of